Hey guys, welcome back to another video by Fully Informed Trade, or FI Trade for short. My name is Alex and I'm just going to go ahead and review the stock, commodity, bond, and Forex market. So without any further delay, let's go ahead and review these key markets. First of all, dollar index does seem to be a little flat. And remember, when you see the dollar index a bit flat, generally speaking, you see the market's a little flat. You need a movement in one direction or the other for markets to react in tandem, but in the opposite direction. Currently, dollar index is trading at around 77 and 10 cents. Now let's go ahead and review the next chart, which is the Euro US dollar. Euro US dollar does take a hit and it has pulled back a bit, but it is at newer highs and it has touched the 138 level that I was anticipating. However, if we look at the day's session, it hasn't necessarily, it has closed above at the 138, but then again, it just, kind of pulls back as well. Now, key thing here, I want to focus on the economics a bit. It's not just the U.S. Federal Reserve that's, manipulating these currency markets, like some people would have you assume. There are also other entities that are also manipulating the US dollar. One of them being the People's Republic People's Republic Bank, which is basically the Chinese central bank. Now what happens is that when China manipulates their currency, they take the Chinese yuan and then they convert it over into the US dollar. Now what that does in turn is that it causes the Chinese yuan to go down in value and the US dollar goes up in value. Now because of that, as consumers, we can buy Chinese goods at a marginally cheaper price, making it easier for China to basically compete on the export end. However, on the downside, Chinese consumers within the domestic market of China have a harder time buying imported goods from foreign countries. So the domestic people of China do suffer. So the People's Republic of China have to pay higher prices on goods that they import outside of China. Now that's the main reason why it is hard to enter into the Chinese market, mainly because these consumers are strained by their really tight budgets, and anything that comes out of the United States that's trying to be sold in China has to be sold to the mid to upper class. Now that's the main reason why automobile companies actually enter into the Chinese market and hire domestic employees to basically create products at a cheap enough of a price to be able to compete with Chinese domestic companies. And that's the whole thing that really irks the White House. That's pretty much why Obama went on his campaign to free up trade in the Asian countries, because of this type of manipulation. Now to add even further fuel to the flame, what the Chinese central bank does is that once they convert their Chinese yuan into the US dollar, which pretty much accounts for 75% of whatever China has on their books, because whatever the money they get, they basically convert it into the US dollar to keep the value of the yuan down. It makes sense, and also since the Chinese yuan is inflating at a faster rate than the US dollar, it would make sense to hold on to the US dollar that isn't inflating at as fast of a rate. It would preserve their the Chinese central government's wealth for a little longer. But what happens with the Chinese government, as they take these, as they sit on these US dollar bills, they have a tendency to divest themselves, and they basically buy into the Euro US dollar, they buy into the Australian dollar US dollar, the British pound US dollar, and basically what they're doing is they're manipulating our currency, and we really can't do anything about it. And the smartest thing about it from the Chinese central bank standpoint is that, hey, we're going to buy currencies that are basically appreciating in value in proportion to the Chinese yuan. Likewise, we are going to preserve our wealth for a little extended period of time, making it so that when we convert it back into the Chinese yuan, it will equate into maybe 9 or 10 yuan per US dollar, or maybe 15 to 20 yuan per euro, or maybe 15 to 18 yuan, Chinese yuan, for a British pound. And that's basically that's pretty much the game the Chinese central bank is doing. Now along with that, you got the Federal Reserve buying up treasury bonds in order to push investors out of the bond market, so in order they invest into the stock market or at least convert it into cash so that it can be spent on the real economy, hire more employees, or whatever that needs to be done. So that's pretty much the basic thesis behind what the Chinese central bank is doing and what the US central bank is doing. Now let's go ahead and look at the next chart, which is going to be the Dow Jones Industrial Average. Dow Jones Industrial Average, like I was saying, it was flat. Now if you go ahead and look at the dollar index, I'll go ahead and show the same exact chart to you, and you pretty much see a flat day on both. US dollar index flat, Dow Jones Industrial Average was flat as well. Now let's go ahead and look at the next chart, which is the E-minis. Now the E-mini S&P futures are basically, and I'm basically showing you what it's doing after the trading session is already over, and pretty much it has gone a bit lower, it has gapped a bit lower, and the main reason you can attribute that to is the Euro US dollar, as the Euro US dollar does have a decent enough of a pullback on the day's session, and futures traders, they kind of have the leading edge, and they kind of do get to trade 24 hours a day. Now let's go ahead and look at the next chart, which is the gold market. It is trading relatively flat, and the main reason why it's trading relatively flat is mainly because of the fact that the currencies are a little distorted, as I was mentioning earlier. Remember, every time the US dollar is used to buy into some other currency, from a Chinese central bank perspective, what basically happens is that the US dollar continues to devalue, and that in turn basically distorts the picture from what actually should be happening in normal market case scenarios. So now these gold investors are kind of stuck thinking, hey, the US dollar is going down, but the main reason why it's kind of doing that is because the Chinese central bank has some of it has to do with the US Federal Reserve, and some of it just has to do with Forex traders riding different trends in the markets. Now, as I approach the gold market, this is how I would do it. First of all, I would not recommend a single type of trade because it is very unlikely that you're going to be able to determine where this market is going to go precisely. That's not to say, though, that we are kind of looking at somewhat of a trading range. If you zoom in a bit further, it looks somewhere around the 1,340 to 1,320. But remember, I wouldn't really hold my breath on this yet because gold does have a tendency to move really fast. And for you highly leveraged traders out there in the gold Forex or gold futures market, it would make it relatively risky to basically choose sides right now in light of recent events. You got a typhoon category 5, which is twice as powerful as Hurricane Katrina, slamming into Queensland, Australia. And you also have another issue in Egypt that's really uncertain. There's no clear picture of what exactly is going to happen. Nobody trusts the president. The president demands trust from the citizens, and all the while there's this chaotic infighting amongst different citizens as well. So as you guys can already see, the situation isn't really that spot on and clean and clearly defined for you to make a trade in the gold market. However, if gold market does have a huge upsurge, it has more likely to do with things turning for the worse in the Middle East. And like I'm saying, terrorism is a possibility in light of all this chaotic, basically in all this chaos in regards to Egypt. Now let's go ahead and review the silver spot. Silver spot, same story to a degree. It is trading a bit flat. I don't really trust the markets right now, especially with silver and gold. It's really hard to say. So I will pass up any type of trade in silver or gold at this point because there's no telling what type of events could come out of China, or but more importantly out of the Middle East and Australia. But more importantly, there's no telling what people are going to do because it's a really mixed bag right now. You have the US dollar kind of flattening out. It might go up. That in turn could cause gold to go down, but if it becomes chaotic enough again, then gold could go up. So basically, if the US dollar rallies without things becoming worse in the Middle East, chances are gold will fall down. Now, if things get really bad in the Middle East and more countries have issues similar to that of Egypt, then chances are you are looking at a case scenario of the gold market going up, dollar market going up, bond market going up, but then it might pull back on Chinese manipulation as they convert those US dollars into different things like the euro US dollar, pushing down the value of the US dollar again. So like I'm saying, it's all up in the air, and there's a ton of manipulation from both central banks, from the two largest economies in the world. You're basically looking at a clash of the Titans scenario right now, and it's hard to decide with whichever behemoth, because both are kind of stupid and both are kind of doing weird things right now that makes it really, really hard to analyze what's going on. Now let's go ahead and examine the bond market real quick. Bond market can't get a bid in, but it is at the lower end of the range. And you know, we've had a great run. Every single time we would buy towards the lower end of the range, somewhere around 119.60 to 119.40 was a good risk to reward ratio. Now remember, if things get bad, you should always have a stop at the 119 area as well. So you know, pretty decent risk to reward. We've seen this area hold multiple times, 1, 2, 3. It might hold a fourth time, but that's only if, and that is basically only if, the US dollar basically continues going lower, then maybe. Well, you know, actually these correlations are a bit broken. If the dollar index does go higher on fears of Egypt and Middle East going worse, then there will be a bid in the US dollar, which would cause a bid in the bond market. Now, if there is nothing that, you know, nothing serious erupts out of Egypt, then you won't see a bid, particularly in the bond market. But if market participants decide to bid up the dollar index again, then that in turn will cause the bond market to continue going lower, based on standard correlations. Now, this is part 1 of my video. I will go over the crude oil markets and my various stock plays in my next video. So just hold tight, and we'll see you in the next video.